When I got into real estate investing, I was in my early 20s. The market was great. If everything just didn't work out, I didn't really care. I wasn't using investor money. I wasn't going to lose anybody else's money. I was using my own money. And if I made some mistakes, all right, it was my own money. I always thought of it as tuition.
Welcome to the Multifamily Wealth Podcast. I'm your host, Axel Ragnarsson, and on this show, I dissect how seasoned multifamily investors started, built, and scaled their businesses.
What's going on, everybody? Welcome back to another quick solo episode here on the Multifamily Wealth Podcast. In this episode, I'm going to be talking about something that's a little different than what I usually discuss on the podcast. And it's about taking risks in your business or just investing, I guess, in general, and how to think about taking risk from a fear standpoint, which is, I know, what stops most people from ever investing in real estate or really ever scaling their business and taking those big incremental steps, whether that's doing larger deals, whether that's working with new partners, vendors, whether that's getting into a new market, et cetera. A lot of the challenges with doing so are fear-based, which makes sense. And I want to talk about those in a second. And this content is a little bit different than what I normally talk about on the show, which is much more tactical. Here's how you grow your portfolio, grow your business stuff. You know, tactically, how do you find great deals? Tactically, how do you operate your properties well? How do you structure partnerships? You know, a lot of what I talk about here is the actual work, right? What do you need to do? What are the tips for the work that you got to do? This is a little bit more, mindset, which is not something I talk about on the show because it's not something that I really care about that much or really think about that much. But I think this is something that is really important for folks at this point in the market cycle. And I think this is a very topical episode, one that applies really at any point in time, but specifically right now, where there's all kinds of uncertainty in the marketplace. We don't know where the values are going. We don't know where rates are. We don't know how long rates are going to stay elevated. We don't know, we don't have the conviction in our underwriting that maybe we did a couple years ago. So something that I'm telling myself a lot right now is as we're evaluating deals, as we're evaluating key changes in our business, whether those are hires or, again, entering new markets, all of this different stuff. I think oftentimes people are constantly thinking about what happens if this goes wrong, which is critical if you're investing in real estate, right? You want to protect your downside. That is the most important thing that you can be doing. However, we also need to think about the cost of inaction. What happens if we don't take action? What happens if we don't make this decision? And, a question that I oftentimes ask myself, right, as we go through the different, as we make the decisions I just mentioned are, what happens if you don't do this? Whatever, and this equals whatever the decision is, right? And I just listed a handful of them. What happens if you don't do this? What happens if this actually works out? What happens if this decision works out? And there's a common saying in investing, pessimists are oftentimes right, but optimists are the one that get rich. Again, pessimists are right when the market tanks, but optimists are right the other 70, 80, 90% of the time when the market isn't tanking. And this is just a different spin on that. And really what I'm trying to convey here is that oftentimes thinking about the potential upside, the upside ramifications of a decision helps to, remove some of that fear, helps to remove some of that paralysis that can come with only thinking about the downside. And again, this is all within reason. You need to protect your downside as a real estate investor, but you also need to be thinking about the long-term upside and making some investment decisions, or just applying this to your life in general, taking that new job, making the move to the new city, doing, jumping into, a deal with so-and-so, a partner, what have you, whatever it is. And this is much easier done at different stages of your life, right? When I got into real estate investing, I was in my early 20s. The market was great. If everything just didn't work out, I didn't really care. Like I wasn't using investor money. I wasn't going to lose anybody else's money. I was using my own money. And it was, if I made some mistakes, all right, it was my own money. I always thought of it as tuition. And that's easy to do when you're in your early to mid 20s and your living costs are low and you don't have a family to support or anything like that. So if that's you and that's the season of life that you're in, who cares if you lose money? It doesn't matter at all, right? It sets you back temporarily, but you have so many years in front of you to build your earning capacity, to make it back and to take those risks again, right? Before you're still even at the point to where you can't do it. And that's, if you are, and this is a bit of a sidetrack, but if you're listening to this and you're in your 20s, like, take risk. What are you doing? There's no reason to not be doing that, because you're never going to be in a better position to take both financial and lifestyle risk ever again. And we're entering a stage of the market cycle where risk takers are going to be rewarded. And I'm not somebody who's on this podcast trying to tell you that now is the best time to buy real estate. I don't really think it is. I think it's a really hard time to buy real estate right now. because it's hard to feel confident in your underwriting. And we're not at the bottom. Like there's a lot of folks that are just gurus on podcasts, on social media going, now is the best time to buy multifamily real estate ever. It's like, no, it's not. It's not the best time, right? The market is starting to adjust. It's starting its descent. We are not at the bottom, contrary to what some of these gurus will tell you. No, we're probably a good 18 months away from the bottom. We're going to be heading down the roller coaster, so to speak, for a while. Prices crashed in 2008, but they didn't bottom out till 2010, right? It's a multi-year process. But again, that's a sidetrack. But what I'm trying to convey here is that while there's a lot of fear in the marketplace, it's going to take a lot of guts as an investor, whether it's today, whether it's 12 months from now, whether it's 24 months from now, potentially, to make those investment decisions, to feel confident enough to pull the trigger with your own money or with investor capital. And if you're looking at a deal and you've really thoroughly analyzed the downside and you're realizing that fear is now just the only roadblock between you and making a decision, start doing some exercises based on what happens if this does work out, what happens if I don't make this decision, and start game planning what it could look like from an upside scenario. And Tim Ferriss, I don't really listen to his podcast, but he released an episode, I think it was like 6-9 months ago. I don't know how long ago it was. But it was basically him talking about an exercise that he does called fear setting, which I thought was a really, really interesting concept, where when he's looking at a decision or he's about to make, some kind of important decision, investment, lifestyle decision, he does what he calls a fear setting exercise, where he literally lists all of his fears and then he keeps pulling the thread until he gets down to the absolute most core components of whatever that fear is, right? Whether it's he used moving as an example, and I think he described it as, I have a hard time making friends, I lose my job after I make the move, and he just starts analyzing. And then you actually really start to realize that the downside scenarios aren't oftentimes as severe as you may think. And then on the inverse, it's like, what happens if all of this does work out? And then you list all of the scenarios in that situation. And actually taking a holistic approach to this analysis, I think, is really helpful for a lot of folks. And this is something that I've started doing. And I'm not really a big mindset guy. I don't buy into a lot of that stuff. Or it's just not something that I think about a lot. But fear is a huge thing for any investor, especially professional investors out there that are raising investor capital to go and invest. And you have a lot of emotional weight tied to that whole process because it is a very stressful process. That's where you maybe need to be doing some of these things. So to summarize, analyze the season of life you're in. Analyze what type of risks that you're able to take and recover from. Analyze the fears you have around your decision and actually start asking yourself the questions, what happens if I don't do this? What happens if this works out? And you'll probably find yourself thinking about decisions in a slightly different way. And I'm going to use one last final example to tie this all together. It's similar to the one I used, but I really want to convey this. If you're in your late 20s, early 30s, you have a long you have plenty of working years ahead of you, even if you're in your mid-30s. Focus on increasing your earning capacity and take some risks with that capital. And risk could just be as simple as buying a property. And usually the first deal is the one that really people have a hard time with, which makes sense. That's the biggest leap you're going to make in your investing career, is just doing that first deal. Let's say you have $50,000 in the bank and you're looking at, do I go throw 10,000 of this in the S&P, 10,000 in my emergency savings, 10,000 in an IRA, and maybe I got, 20,000 left to play with. Let's game plan it this way. What happens if you put all $50,000 down on a property? And these are just hypothetical numbers, right? Assuming that you can do that, right? Maybe you're in a higher price market, you got to tweak these numbers. What's the worst that happens? Like truly, what's the worst thing that happens? You lose all of the money. That's the worst thing that happens. I guess the other worst thing that happens is you default on the debt. Let's hope, that is a real extreme. Let's hope that you don't get to that point. You're buying an income producing property. You've hopefully bought something that we've analyzed the downside and you're able to support things. You can jump into the management yourself. You can start doing some of the work yourself and you don't let it get to that point, right? Ideally. But let's use the downside scenario. You lose all your money. Okay, that sucks. What would have happened if you invested that money in the S&P? You probably also would have lost a very large chunk of that money, right? That's what happens when the real estate market tanks. It's also coincides with the equity markets taking a hit as well. So you're losing money in both situations if you're investing. But what about the tuition that you gain by investing in real estate and going through that process? What happens, just in general, as it relates to you now understand the process of investing in real estate? Yeah, you've got some scars, but you understand the entire process. And now you know exactly what not to do the next time. You know exactly what to avoid, whether it's from a deal standpoint or an underwriting standpoint. And if you start to ask yourself the questions of what happens if this works out, what happens if I don't make this decision? Well, if I don't make this decision, I don't give myself the chance to actually experience all the potential long-term upsides of investing in real estate. I don't give myself the chance to learn all of the fundamentals of buying a piece of real estate, of operating a piece of real estate that I can then apply to future deals. I don't put myself in a position to help start replacing my income. And again, you can just start pulling this thread. But when you think about the potential upsides of that decision versus the potential downsides, obviously we all invest in real estate. That's why we listen to this podcast. So I'm preaching to the choir, but it really starts to make a lot of sense, right? It starts to pale in comparison, right? The downsides pale in comparison to all of the potential upside in making that decision and actually getting, jumping into the water and actually going down that road. So I'm already dragging along here on this episode, so I'm going to wrap it up, but start to think about the ramifications of not making decisions, of not taking some of these risks, and ask yourself these questions as we progress over the next 12 months, 24 months. And as investing gets harder because people's conviction is lower, right? Ask yourself these questions, try and get away from purely the fear that you feel when making these decisions and actually start to think logically about all the upsides of making all of these decisions, right? Whether it's investing, whether it's making leaps in other areas of your life, business, etc. So hope this was helpful. Hope this was a mental reframe for some of the folks out there. If you enjoyed this episode, please leave the podcast a rating and review and share it with anyone you know that it might also benefit. Helps the show get noticed by more folks, as we all know. And I'll catch you guys next week.